Hi, I'm Chance Finucane, Chief Investment Officer at Oxbow Advisors. There's been a lot of price movement in the financial market over the past month. Here's what grabbed our attention. Sentiment towards stocks was around record highs coming into the month. The only prior times it reached this high of a level in the 21st century was 2007 and the end of 2017, both preceding difficult markets in the year ahead. Exuberance around several secular growth trends has driven the price of the S&P 500 ahead of what the fundamentals would suggest is fair value. From 2014 to 2019, the S&P 500 traded at about a 5% free cash flow yield. We consider this a pretty fair price. In early 2020 and late 2021, price ran ahead of free cash flow, only to later return to a more attractive valuation within a year. The same thing is happening now. A 5% free cash flow yield would mean the S&P 500 price of about $4,500, nearly 20% below the current price. Technology businesses are the primary driver for this run-up in price. After an amazing 2-year run, the share of the S&P 500 that is represented by tech and communication services stocks is near an all-time high at around 40% of the total market. The concerning thing with tech stocks is the relative valuation of them versus the market looks similar to prior bubble peaks. The free cash flow yield of the tech sector is trailing the free cash flow yield of the total stock market by a similar amount as the peak of the mainframe era of the 1960s, the 2000 dot-com bubble, and the pandemic peak in 2021. A lot of good news is already priced into these stocks. It means the risk versus reward calculation on these companies does not look appealing. The main reason for the slowdown in free cash flow growth is the big jump in capital spending by these large tech businesses. Alphabet, the owner of Google and YouTube, is a good example. CapEx spending stayed around $20 to $30 billion per year from 2018 to 2023. Now it's jumping to $50 billion for at least this year and next year. It's hard for the share prices to keep rising if the free cash flow production does not grow along with it. We think this overconcentration in a single-digit number of tech stocks is an opportunity for investors. Typically, the correlation between the regular S&P 500 index and its equal-weighted version is near 1. It means on average the two indices move in a similar fashion. That's not the case today. The correlation of the two indices over the past 3 months is around the same low level that we saw at the peak of the dot-com bubble. That was also a great time for active stock selection in good businesses that had gone unnoticed for too long. This convergence in performance between the loved and unloved parts of the stock market began in earnest over the last few weeks. The NASDAQ 100 and NASDAQ composite indices were up more than 20% year to date in early July, while small cap stocks represented by the Russell 2000 had not grown at all. Look now, and the NASDAQ 100 and Russell 2000 have nearly the same year-to-date return through July 30th. This was a record level of outperformance for small cap stocks over a 2.5-week span. Small cap stocks outperformed large cap by more than 12% over 12 trading days. It's the highest outperformance this century. Value stocks also had near record outperformance relative to growth stocks over the same 12-day period. We are less confident that the appreciation in small cap stocks has legs because it's against a backdrop of slowing economic growth. Small cap businesses are more reliant on a healthy economy. However, value stocks as we would define them, which are companies with better than average free cash flow yields and consistent cash flow generation, are an area that we think can continue to outperform. There are two other notable moves happening in other asset classes. First, Treasury yields have been declining for the past 3 months. We think this is in reaction to slower economic growth ahead. When economic growth is slowing and yields are dropping, it's a good time to own utility stocks, precious metals, REITs, treasuries of various maturities, and investment-grade corporate bonds. We have been adding in all of these areas over the past quarter. The second notable move outside of the stock market is the decline in commodity prices. Falling commodity prices are another signal of weaker economic growth. We still like our exposure to the precious metals market, which moves with a different set of variables than economic growth, and our exposure to pipeline stocks since they are less reliant on a rising oil price for cash flow. But we are being mindful of any other cyclical commodity positions we own and will be quick to sell if we see more deterioration in this sector. Hopefully that gives you a sense of what we're tracking today. If you have any questions or would like to learn more about Oxbow, please contact us. We provide the information that we think is most valuable to investors. If you'd like to follow our work more closely, please subscribe to our YouTube channel.